The proceeding will start shortly. 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 The proceeding will start shortly.
Session of the Economic Affairs Committee. I'm delighted to welcome Andrew Bailey, Governor of the Bank of England. Before I go any further, I should register my interest as an advisor to Banco Santander in Madrid. Governor, very good to see you here today. Interesting figures came out this morning. Undershooting forecasts in inflation. How would you describe them? Good news?
Yes. I mean, in fact, actually, to be honest, we slightly overshot last month and slightly undershot this month, so it pretty much leaves us where we were. But I think if you look under the surface, there's a bit more to it than that, which is the encouraging bit. That the reason that we were expecting a small tick up in inflation this month was because of these so-called annual base effects, which are in the sort of arithmetic, because they're basically a sort of mirror image of what went on a year ago. So they were there. I mean, nothing's changed on those. They're in the arithmetic. So what it means is that there was some more other things going on which were putting more downward pressure on it than we expected. So that's good news. And as far as I can tell, looking at it this morning, that downward sort of that amount of sort of downward movement was pretty broad-based. A bit of it in energy, some in food, but also some in services as well, a little bit. So that's quite encouraging. So yes, I think it leaves us broadly where we thought we were going to be. But that's obviously encouraging relative to where we could have been.
So Hugh Pill said earlier this month, I think, that, and I quote, that moment at which bank rate cuts might be possible is still some way off. Would you think that what we heard today and yesterday in particular changes that?
I don't think it broadly changes the picture from where we were with the February monetary policy report. These are pretty small numbers actually in terms of differences. I mean, just to reinforce what Hugh said, I think, and I made this point at the press conference 2 weeks ago, I think the big change is that we've moved from, in a sense, facing the question, how restrictive do we have to make policy to get back to target sustainably, to for how long do we have to maintain those stance of policy to achieve that? And that's an important and significant change. And I think today's numbers leave us exactly in that position, actually.
And so just to go a bit deeper then on this, when you're looking at this issue of persistence,
Yes.
what data are you looking at in particular? I think you've spoken. Can you say a bit more about what you're looking at on wages, on the jobs market and so on, and services also?
Yeah, so
there seem to be three categories.
There are three categories. Services inflation, because that has the highest domestic sort of component in it. And just to put the background on that, I mean, what we've obviously seen inflation coming down very rapidly, and really that is the ending of the global shocks to inflation that we saw obviously 2 years ago. We were always putting interest rates up. Sadly we can't obviously use interest rates to deal with the consequences of the Ukraine war. But what we can obviously, and what we're doing, was to stop the second round effects into domestic inflation. And these three things are really trying to capture those second round effects. So services inflation is important because it has a much bigger domestic component. It is still above 6%, so that is not compatible with a 2% sustained inflation target. It's got further to go. But we have started to see signs of it coming down. Second one is pay earnings. Again, we are seeing signs of it coming down. I mean, yesterday's earnings numbers, I would say again, they were sort of billed as sort of slightly disappointing. Actually, of course, there was quite a marked reduction in pay growth yesterday, just not quite as far as we thought. So again, we're seeing that coming down, but we really need to see more evidence of that to really be convinced that we're on track for 2% sustainably. The third one, and this is the one that we're obviously finding the data most challenging at the moment about, is the quantity side of the labour market. So we've had a very tight labour market for some time. The problem we face is that the ONS, who uses the so-called labour force survey, the LFS, to measure it, the LFS has had quite serious problems with the sampling.
Yeah, we'll come on to that.
Yeah. Now, it's affecting more for us the sort of the identification of unemployment and inactivity. There are some other things we can use to, in a sense, proxy employment, and our staff use they use anything, frankly, that we think is a sort of decent proxy. There are fewer proxies of unemployment and particularly the split between unemployment and inactivity. So that's the third thing, and that is more challenging at the moment.
And so just to go and then build on that, are you looking for all three sectors to sort of see persistence easing, or are you looking at one more than other?
Well, in the best world, all three would move sort of consistently. If they don't, then we'll sort of have to sort of dig under the lid and see what's going on.
Yeah, and I was reading with interest what Swati Dhingra, a member of the MPC, has said. She's warned that you may be underplaying the downside risks for the UK economy, and has called, obviously, voted for immediate rate cuts. What would you say then in response to that in terms of these figures that we've seen in the last 48 hours?
Well, of course, on the growth question, it's tomorrow that obviously we're seeing the GDP number on activity. So that's the third one of the week as well, because it's a big week for data. I think there might be, my sense is this. Last year, overall GDP was basically flat. Now, whether we will find out whether we had a so-called technical recession or not, depending on what the fourth quarter number is. In our February-March policy report, frankly, it was in the balance. We didn't have a recession in the forecast, but it's at best flat in the view we took. So, it wouldn't take much to tip it either way, frankly. I would say, actually, underneath that, just quite an important point to make underneath that if you split that overall GDP number into what we call the market economy and the sort of the government economy, actually the market economy was negative last year, and the government economy was positive. And by the way, the quite big GDP revisions we had were really all on the government economy. This is things like health and education. Now, going forwards, however, and I said in a speech I gave on Monday, and I think this is in some ways more significant. I think we are now seeing some signs of the beginning of a pickup in some of the surveys, for instance. And certainly the view we took in the report we published 2 weeks ago, we've got a modest pickup this year, which continues thereafter. That is also being helped by the fact that we've got a lower yield curve. I mean, one of the big changes between the November and the February reports was that the yield curve has come down quite substantially.
Thank you very much. I'm going to move on then to Lord Burns to talk about other aspects of this.
Thank you, Chairman. I should also declare my interest as an advisor to Banco Santander in Madrid. Afternoon, Governor. Some commentators have argued that the bank paid too little attention to the rapid expansion of broad money in the early stages of the pandemic and the danger that it implied for overheating. And more recently, broad money growth has been very weak, as set out in your report, and even negative at times. Some of the same commentators are now saying that maybe the bank is paying insufficient attention to this, and we would like to hear your response to
certainly.
that challenge.
So we certainly do pay attention to it. I think the thing that I tend to pay most attention to at the moment is, and we had a chart of this in the report actually, is the relationship between the stock of broad money and nominal income, or nominal GDP. Because that gives you a sense, I think, as to whether there's a sort of overhang or underhang of money. Now, what you see is that it is actually now, just now, back to the pre-COVID trend line. There was an overhang during COVID. No great surprise there. I guess. I mean, we know that story, but having to get back over it. But what we've seen in the last year or so, a bit more now, has essentially taken that ratio back to its trend line. Now, obviously, the question is what happens next on that front. The change in broad money, I mean, in the broad money measure, I think it's becoming less negative now. It's sort of trending back to flat. But we will watch that carefully, because I think that's a better indicator than the sort of month-on-month change. The problem with the month-on-month change is that our staff always come in, and you may remember there's always something in there involving some non-financial institution of some sort or other, or other financial institution, and it sort of gets quite cloudy. But I think that ratio is actually not a bad indicator of what's going on.
And you also showed that ratio for the domestic sector.
Yeah, you can do the household
in the report
household sector, yeah.
And the story was much the same there.
Much your electric example. Yes, the story
was much the same there, if I
yeah.
remember, which is that
Much the same.
although there has been this deceleration and indeed some negative movement, that basically we are now back to what might describe.
Yes, if you draw a sort of trend line pre-COVID, we're back to that trend line. Yeah.
So this is going to be in the end a debate between rates of change and
Yes.
the extent of getting back to levels, and we will learn about this in time.
I mean, I think we should be. I mean, the way we should be. I mean, if you take the view, and I know this is obviously quite highly disputed, that there were extraordinary circumstances during the COVID period, then those extraordinary circumstances have now gone, and we should be back there in a sense.
Baroness Liddell.
Thank you. I want to take you back to labour market. For a start, how much confidence do you have at the moment in labour market statistics? I got the impression from what you said earlier that there is a degree of uncertainty.
There's quite a degree of uncertainty. I mean, I think the problem is, obviously, it's done on a sample. I think the completion rate of the sample was, or the sample size, therefore, was actually declining before COVID. What happened during COVID was necessarily the ONS used to do a face-to-face interview. They'd actually go and see members of the sample and ask them these questions. I mean, because on things like inactivity, because there's a lot of follow-up questions about what's causing you to be inactive and so on. And obviously they couldn't do that face-to-face during COVID, so they switched to telephone. And the problem is that, generally as a nation, we don't answer the phone if we don't know who's on the other end. And the sample size has gone down. Now, the ONS did do some things to actually supplement. They put more people onto that work during COVID, but we've observed the sample size going down, and we've also observed for a little while that the numbers were becoming more volatile in the short term. And these are numbers that you wouldn't really expect to be particularly sort of short run, don't have trends in them obviously, but you wouldn't expect short run volatility going both ways. Now, the ONS have now published also an so-called experimental statistic. I have to be honest, I mean, our staff have advised us that, you know, whether unemployment is currently 3.8% or 4.2% is really pretty hard to judge. And the ONS are now working on a new method that they're going to release later this year. So it is a problem, but it's also a problem in this, because this is the thing that's become much more important, is this split between inactivity and unemployment. And particularly what the underlying reasons for inactivity are, and whether we think they're going to sort of be permanent or temporary. That is causing us challenge. I mean, our staff, you know, do a lot of things to proxy. Our regional agents spend a lot of time asking firms for their side, their side of the story. So we try to build it up as best we can. But it's easier to do that on employment than it is on unemployment, because it's obviously easier to talk to the sort of firms who've got employees than it is to talk to people who are not in jobs.
It's quite interesting whenever you actually look at what is happening with inactivity in the labour market, and it does breed a degree of quite considerable uncertainty. Figures out today look a bit scary, in fact. Yeah. But how much agreement is there on the MPC regarding wage dynamics? Because if you look at immigration now, which is aimed more at the skilled market, then the wage dynamic is actually quite important in that. Well,
it is, and I mean, my colleagues have set out their own views in speeches, and it's in the minutes. I mean, it is one of the areas where if you sort of took the views of people who vote different ways, I think that does feature quite strongly in the reasons for why they do have this different view as to what, and then that's looking forwards as to how pay is going to evolve. The other thing I should say that is a challenge for us is, and we've published this in a number of reports, is that we have a number of models in the plural that estimate wage equations, none of which, frankly, has performed well. And so I've used it a number of times. We have a chart which shows, essentially the committee is setting up a path of wages looking forwards, which is I have to be honest with you, this is entirely judgment. It's not model based at all. Now, when I say judgment, we get a lot of input from our agents. They do a survey every year. They've just done one as to what firms think their settlements are going to be this year. So we obviously use a lot of information. But that is the other area that's become problematic in terms of the sort of forward-looking view.
This is quite worrying, though, it sounds like. I mean, it sounds as if you're maybe not flying blind, but you've got serious challenges.
Well, it's one of the reasons that I was very keen to get Ben Bernanke to come, and I was delighted when he agreed, because I know there's probably somewhat of a difference of view on this. For me, it's not a question of are we sort of blindly following a model. It's actually, we've got a number of models and none of them are frankly delivering things that really we've got much confidence in some of the, not all the apps.
We'll come on to the models.
Some of the outputs.
Yeah, I'm thinking also just about the inputs in terms of the ONS data. I mean, it does strike me from what you're saying that there's quite a big challenge that you face, and obviously
yes,
the Treasury
obviously the inputs shape the outputs. So so yes, it is a challenge. It's also a challenge, to your question about exactly what are the reasons for inactivity and what do we deduce from those reasons in terms of what might happen in the future.
And are you confident that the ONS is now saying it's not going to get the new LFS, I think, up and running until September, I think I'm right in saying? How confident are you that that is actually going to now happen in your conversations with them?
Well, I don't know, to be honest, because I don't think we're sort of close to the really detailed sort of work on the sample and so on and how they're going about it. I think, I'd say my own view when it was delayed was I wasn't surprised, because it struck me it probably would require longer to put this thing in place, given the sort of problem that they've got, which is quite obviously quite a deep-seated problem in terms of how you collect this information.
Right. So just on that, I mean, is it just so we can just peel away the problem? It's the NFS. I was also very struck by the actual immigration population statistics. Is that an issue as well? I mean, I'm just trying to scope the problem that we're facing here.
There were some problems in the population data and also in some of the underlying elements of the labour market data, because I know up until recently, for the last year or two, they'd assumed the population was no longer ageing, which of course, unfortunately, sadly, we all are, and that they've corrected that. We are not, I think, particularly at all well qualified to judge the immigration statistics as they are. We take those as given, to be honest.
Right. Thank you. Lord Blackwell?
Governor, I don't expect you to comment much further on short-term interest rates, but I would like to ask about your views on what the long-term might hold. We've had a period of very low interest rates, and the rate of 5.25% now is generally regarded as high, but that's after a period when for a decade real interest rates were negative. Your predecessor espoused the view that there was a permanent excess of savings in the world economy that was depressing interest rates, and therefore we could expect continued low rates. But if you look forward, the 1-year gilt is just below base rate, but the 10-year gilt and the 15-year gilt are still above 4%, which, if you assume 2% inflation, is a 2% real interest rate, and wouldn't suggest much opportunity for a fall in rates from where they are now. So I'd just be interested in your view of what might an equilibrium rate in the long run look like.
Yeah, I mean, I think the reason that Mark Carney said what he said was that I'm going to divide this up into what I call the long-term sort of equilibrium rate, and then the shorter terms, more cyclical, because they're importantly different. The long-term equilibrium rate is really, for an open economy like the UK, it's a global thing, really. It's shaped globally. The point he was making about saving is that obviously there is the world has an aging population. And older populations save more, and that's reflected into that assessment. So that sort of determines the supply of saving. And then we've had very weak productivity growth globally since the financial crisis. So that, and certainly if you look at the UK, weak investment, and so that sort of determines the demand for investment. And the interest rate is the sort of equilibrating price of those two things. So that's the argument for why it came down. And of course, if you follow that line of argument, those things are very slow moving because, unfortunately, the world's population doesn't stop aging quickly. I think now, though, there's a second, possibly more important element, and is what we tend to call the shorter-term cyclical equilibrium rate. And I think there are good reasons to think that has gone up a bit. Particularly as we were following on the discussion we were just having about the labour market. The labour market is tight. I mean, whatever the numbers that really are, it's clearly tight. I mean, it's interesting that we've got a restrictive monetary policy at the moment that's pushing down on demand. Inflation is coming down and unemployment is not going up. Now, that's a good thing, of course. I don't want to, in any sense, come across as decrying that, but it's interesting that we're in that situation. So what I would deduce from that is that the shorter-term equilibrium rate has probably gone up. That suggests to me, I can't give you a number, but I would say, if you said to me, where do you think it will settle at some sort of point in the not-too-distant future, in the medium term, I would doubt we're going back to zero. I don't think we're going back to zero. It'll be lower than it is today because it is restricted today. It'll be somewhere in the middle, probably.
Positive real rate.
Sorry?
A positive real interest rate.
Yes.
Okay. Can I just follow up then one point on the discussion you were just having about the labour force and the tightness in the labour force? Clearly you and others have been in the bank have been making the case for moderation in wage demands in order to control short-term inflation and keep being interest rates.
What I say about that, but yes.
But we are in a period of labour shortage, and probably, given the points you just made about ageing population, permanent shortage of working age labour, and without continued massive immigration, that's likely to continue. I'm struck by, I'm not a historian, but I'm struck by reading that at the time of the Black Death in 1350, when the population halved, there was an attempt to control wages by law, which failed. Real wages grew significantly, and in the 50 years after that, there was one of the fastest growth rates in GDP per head until the Industrial Revolution, because of the pressure on productivity. I'm not trying to draw exact analogies, but do you think we actually need to adjust in the medium term to a higher wage economy?
There's a book come out recently which actually covers a number of the big supply shocks in history, of which that's one of them actually. It sort of assesses it. It's quite interesting. I read it just before Christmas. Well, I think, as I said, we do have a tight labour market. And by the way, I was in the East Midlands yesterday. When I go around the country, it's very clear, and it's been very clear for the last two years, that companies have said to me, they were going to retain labour even if there was a downturn in activity, because they were concerned about how to rehire labour, for when they needed to do that. So we've certainly seen that going on. I think on pay, what I would say is this. I think what we're seeing, and I would expect to continue to see, is that as headline inflation comes down, and then of course people actually have to be, understandably convinced that it's going to stay there and come further down, that feeds through into inflation expectations, and that will feed through into wage bargaining. I think we're starting to see that. That's not, I'll be very clear, that's not me preaching something. I think that's a mechanism that I would sort of expect to see. And then, of course, you're right, it will be shaped by how tight the labour market is. And certainly, on the supply side, I mean, we've just done our annual supply side stock take, as we call it, of the various components of the supply side. We do see a tight supply of labour in that sense.
You've done Lord Battle, that's fine. We're going to bring in Lord Lonsborough and then Lord Turnbull. Lord Lonsborough.
Thank you, Chair. Governor, if we can follow up on the labour market, and specifically, I'd like to get your views in relation to productivity, which, as we know, remains stubbornly low in the UK and has done since the financial crisis.
Yeah.
How much of a concerning factor is productivity in the thinking of the bank and the MPC when assessing the labour market and wage dynamics? And I'm thinking in particular about the real cost of labour in relation to its output. Employers in the market economy, which you were pointing out was particularly struggling last year, are paying almost 7% per annum when productivity is probably below 0.5%. What are your views on that?
Well, you're right that we've had very weak productivity growth really since the global financial crisis. Now, that's not limited to this country, although this country has been quite a pronounced case, but it's not by any means limited to this country. And I think that is a problem. So for us, I mean, the issue for us, of course, and it's why we do this, we obviously do these supply-side stock takes, is that obviously monetary policy is the balance between demand and supply. So we have to have regard to, the growth of the supply side of the economy, and the supply capacity growth at the moment is very weak. I would say it's weak. I also say, if you don't mind, I mean, I've been following the hearings you've been having on public debt. That, of course, it is an issue there as well. I mean, if we're going to adjust debt levels, then growth free of the supply side and productivity growth would be important there. It's significant, and it's interesting, I think, to look back to the post-Second World War period on this, because obviously we came out of the Second World War with a lot higher public debt level than we have today, actually. It was over time adjusted down, and one of the factors in it, I mean, there were primary surpluses, but there was stronger productivity growth than we have now. So I think it is a very important issue in that sense. It's a very important issue.
Lord Turnbull?
I'm slightly confused. You said older people save more,
Yeah.
and therefore we have an ageing population, savings will be higher.
Yeah.
I would say exactly the opposite, because older people don't save more, they draw on their savings. What we've got more of are people about to become old, they may be saving more.
Well,
So it's a way, but on the other hand, I think you were saying you didn't expect long-term rates to go back down to the levels that they were at. So on the one hand, you're kind of with the kind of view that there's an excess of savings. On the other hand, you're saying that interest rates aren't going to go down to the.
I mean, I
to the
think what I was saying is, and it's really the sort of the so-called lifetime savings hypothesis, it's a sort of Modigliani hypothesis, that over people's lifetimes, they move from being sort of a net debt position to a net asset position. So they do actually accumulate more saving and assets as they get older. Because we pay our mortgages off, for instance,
Yes.
typically.
Then you reach a point, some of us around this table probably know, where you start to draw on those savings.
Well, but I think that's because that's an interesting point, because you're right. The theory is that at that point you start drawing down your savings, but actually the evidence suggests that, of course, none of us actually do to anything like the degree that people think we're going to do. That what has in a sense been observed is that process doesn't actually happen in the degree that it's assumed it will, and that you can attribute a number of reasons. I think some of the reasons attributed is that we want to bequest wealth to our offspring.
Okay.
So just trying to just pull this together, to use Hugh Pill's analogy, we're in Table Mountain, we're on the plateau.
Yeah.
Base camp is higher than it was in terms of where rates might settle, but it's...
Yes, policy is restrictive at the moment.
Yeah, policy is restrictive. What I'm interested in, just picking up on what Lord Turnbull was saying, is, I mean, when you look at what Charles Goodhart's writing about some of this, it's he clearly takes, as Lord Turnbull saying, a slightly different view. Do you really think that rates, I mean, I think I'm right in saying that rates since the 70s have averaged at 9%, and you're saying that they'll be lower than they are now. I mean, for how long is your period that you're saying that covering that for?
Well, I was talking about the medium term, so I don't know,
Right.
you can talk about 10 years, 10 years or so.
Right.
And what I was saying is, I think the long run argument, which I think was attributed, Mark Carney had set out, it would suggest nothing's changed in a sense. We'll come through COVID and all these things and still be in this position where we've got an ageing population. It'd be nice to think we've got faster productivity growth, but we haven't got any evidence of it yet, sort of thing. But I think the point I was making is that I think the shorter term sort of equilibrium, which in the end is the thing that determines the next few years, I think quite a few people take this view, it's probably gone up.
Right.
So that means we will not come back down to where we were pre-COVID.
Yeah. Lord Rooker?
Gunnar, you just mentioned about the productivity gains after the end of the Second World War. I mean, when I had real work before I came into Westminster, it was in the
I was going to say that.
it was in the 50s and 60s.
Yeah.
When I was involved in engineering and manufacturing, the shop floor and management.
Yeah.
The economy is not like that now. So we had a potential for doing things at that time after the Second World War in terms of productivity we don't have now. So is that a serious problem for us, the way the economy has changed? Now heavily dependent on services?
I think we have potential. I mean, there is potential now. I mean, AI is potential in respect. It brings its own risks with it, but it brings brings a lot of opportunities as well. I mean, I can tell you at the Bank of England, like a lot of organisations, we're trying to work out what to do with it and how we can improve productivity with it. So there are opportunities. They can be harder to measure because they're often in what you tend to call the intangibles rather than, I think a lot of the post-Second World War was in sort of tangibles. It was manufacturing and so on. But no, I think there are opportunities, but it's been very elusive for the last 15 years, certainly.
Right. Thank you. Lord Lamont.
Thank you, Lord Chairman. Could I declare my interest as an advisor to the Official Monetary and Financial Institutions Forum? Governor, I wanted to ask you about QT and why the Bank of England is pursuing what some might call a slightly more aggressive policy in QT terms than other central banks. I appreciate you start from a position with a larger balance sheet because of you held no fewer than 37% of government securities at one point. But you seem to be the only major bank selling securities in this way. Other central banks are holding to maturity, a more passive approach. Is there not a danger that you will create a vicious circle, a vicious cycle where prices are driven lower and a lot lower than when they were purchased? There are huge losses and you have to issue more gilts in order to fund the losses?
Well, I would say, by the way, I mean, I can think of at least 2 other central banks that are doing the same things we're doing, the Swedish central bank and the New Zealand central bank.
Not the Fed or the ECB.
Well, the Fed's the Fed's in a different position because the US debt stock has a very short maturity, so the Fed is holding a very short maturity of assets on its balance sheet, so it can rely on runoff to achieve the same thing. We have the UK debt stock is longer maturity on average. We bought throughout, going back to 2009, we bought essentially a representative set of the UK debt stock. So we've got much longer assets on our longer term assets on our balance sheet. So if we relied on passive runoff, then it would be 50, 60 years before we saw it all go off. So that's an important consideration. I would also say this, that if markets are efficient, then the cost of passive runoff is the same as the cost of active runoff. I mean, it's either a carry cost or it's a sale cost. Those two things will equilibrate if markets are efficient. I hear it said sometimes, well, if only the Bank of England would hold these assets, the losses would go away, or cash flow would go away, but that's not the case, actually. So I would just enter that caveat. The second thing I would say is that we do monitor market operations and market efficiency all the time, daily. And at the moment, we don't see any evidence that there is a problem in the gilt market in that sense. In fact, this year, I would say not just in the UK, but globally, the demand for debt from investors has been very high. It's probably because they think interest rates are going to come down. So there's no problem selling gilts at the moment, I would say. Well, obviously, but we'll have to keep watching that very carefully. The final thing I'll say, and this is important for how our thinking goes forward, there are really 2 parts to this story. And it's sort of to do with how our balance sheet works. The total size of our balance sheet, which is coming down, but will ultimately be determined by the demand of the banking system for reserve assets. And we will have to, in a sense, see at what point that demand for reserve assets hits steady state. I said in a lecture I gave on Monday, it will be higher than it was pre-crisis and it will be lower than it is today, but I know that's not a very helpful answer because there's a very big gap between those 2 numbers. Now, that's really not QT. QT is about what assets we hold on the other side of our balance sheet to match those reserves. And the question for us, when we get to the point when we sort of hit this sort of steady state reserve level, which, as I said on Monday, I think will be higher than we thought it would be. The question then is, do we continue the QT, which will allow us to adjust the assets on the balance sheet and will allow us to remove interest rate risk from the Bank of England's balance sheet and put it back out into the market, which I think is what we should do. But we will have a decision. But I think it's a genuine decision to take at that point, and we will have to take that decision, and we will have to expose the thinking of that decision to sort of full scrutiny.
Thank you. Could I ask you about the macroeconomic effects of QT? When you appeared before the TCSC with David Ramsden, it was explained that you needed QT, firstly, to give headroom space for possible future interventions, and secondly, to correct distortions in the market. But the impression was given that there was no macroeconomic effect from QT. And when it was put to you, I think by the chairman of the committee, that this was something of a leap in the dark into unknown territory, you said yes, that's why we keep it under review. Have you had any further thoughts from that review? And isn't it rather odd if you introduce QE in order to achieve certain macroeconomic effects, to argue that QT, an almost opposite policy, does not have any effects?
Well, the reason, I understand the point, but the reason for this is as follows. First of all, we do monitor it constantly. We published an updated assessment of QT in the August Monetary Policy Report last year, and I would expect that we'll do the same thing again in the August report this year. We'll do it every year. And we'll do it at that point in the year because that's when we take the decision on what we're going to do for the following 12 months to come. The reason that they're different is that when we were doing QE, we were not altering bank rate at that. We were using QE as the monetary policy tool because we'd hit the lower bound. Today, of course, we are using bank rate as the primary tool. We're not using QT as a monetary policy tool. And the point I think I made to the Treasury Select Committee, which you were recalling, is that we set bank rates based on the yield curve that we have, and that yield curve will take into account the impact of all the things that go on, including the impact of QT. So in other words, when we set bank rates, we're taking into account any impact from QT, whatever that might be. So it's the fact that we can do that, and it's the fact that we are using bank rate as the primary monetary policy tool, and therefore altering bank rates is what, in a sense, draws the distinction between QT and QE, in that sense.
Thank you. I'd like to ask you about, if I may, the fiscal consequences of QT. The OBR estimated that based on market expectations for the bank rate and gilts, the cumulative net loss that might be realised would be about 126 billion. And before you remind me, of course, I acknowledge that you had profits on the other side of the transaction when QE was implemented. But David Ramsden, at that session, said to the committee, the MPC decisions about the scale and composition of QT will not be affected by value for money considerations. Now, surely somebody has to be considering value for money considerations.
Well, can I make 2 points on this? First of all, those cash flow numbers move around quite a lot. So the number that we published quite recently actually was 40 or 50 billion pounds lower because the yield curve has moved. So those numbers are quite volatile. Probably the more important thing is that I don't think the cash flows are a measure of economic value for money, because they're only a measure of cash flows. They don't actually measure the impact of QE and QT in terms of the economics, and it's more QE in that case. So I think in terms of overall economic value for money, it's a much broader consideration in that respect than just the cash flow. But I would say this, I mean, obviously, as I said earlier, in an efficient market, the cash flow numbers will essentially be the same, whichever strategy we employ.
Could I then sort of widen this discussion on in terms of the fiscal costs of QE and go back in sense to the whole exercise of QE followed by QT? And I was also very disturbed by this notion of seeming to rule out the consequences for fiscal costs of some of the action. I mean, when you embarked on that whole policy, was consideration given to the potential fiscal cost given where interest
when
rates
we embarked on
at the pandemic, the latest round of QE?
Well, I think
was because, and who took the decision about what scale of fiscal cost or fiscal risk could be incurred? Was this a Treasury decision?
Well, the MPC took the decision on the amount of QE to do, but obviously the Treasury has to take a decision to adjust the indemnity that the bank has. What I would say, I mean, about this, and it's sort of interesting to reflect back on it now, that we were in a state of crisis at that point, and the decisions, to be honest, at that point looked very different at the time to how they're sometimes considered now. And I think there was a sort of, if you don't mind me saying so, there was a bit of a, this is a crisis, we really have to act. We had a crisis in the markets at that point, but we also had an economic crisis as well. So I think the cost-benefit considerations looked very different at that time.
I'm not so much questioning that, and hindsight is a wonderful thing.
Yeah.
I'm really questioning the issue of who took that into consideration, because there was quite a large fiscal risk that was going to be involved with it, which may have come out positively. It may, and as we have seen, we've had
it was very
large
hard,
negative, and I'm just puzzled. See, once people make statements like we don't take into consideration fiscal costs, as you might expect, given my background, it sort of rings alarm bells, and so I'm trying to pin down where was that decision taken.
But I think the reason I would say this is because I think the decision was far more in terms of what I would call the economic cost benefits. And obviously that, I would say, you're much more skilled in this than I am, that obviously has quite big, on its own, consequences for fiscal policy. So the consequences of what would have happened if we had gone into a prolonged recession in COVID would have been very different. So I think those were the considerations, not so much the cash flows. Cash flows, of course, were inherently hard to model because you just say, what we don't know what the curve's going to be going forwards.
Sorry, Lord Burns, you?
No.
So can I just pick up on a couple of points I made, Governor? First is to Charlie Bean, who's, I think yesterday or the day before, has suggested that a new lower interest rate ought to be paid on commercial banks' deposits created under QE, reflecting similarly what the ECB is doing with policy of tiering payments on reserves. What do you think about that kind of proposal?
The ECB, just let me explain something about the ECB. The ECB still has in place a policy of, quote, minimum reserve requirements, which we don't have in our system. So we don't have that distinction in our system of sort of two sorts of reserves. All our reserves are the same, so it would be hard to make that change. I mean, I've said before, and it's a slightly blunt thing, that is a tax on the banking system. I don't think that's something that the Bank of England can decide to do on its own. I think that would be a wrong thing for us to do. We'd have to certainly do that with the government. I would also say that that system of paying bank rate on reserves essentially anchors the implementation of monetary policy, because that essentially anchors the short end of the curve at the official rate. So we'd have to be very careful how we implemented anything like that. So I would say that's a pretty big change and not one that I would currently be advocating, put it that way.
Right. Second issue is on the deed of indemnity, which comes back to what Lord Lamont and Lord Burns were talking about. And I'm a bit mystified because about what the Treasury is saying to us on this, because the Chancellor's written to the committee and once again is saying that the Treasury is not going to publish the deed of indemnity. And I quote what he writes in his letter. He says, "It is in line with HM Treasury's risk assessment given market sensitivities related to the document. The disclosure of operationally sensitive information relating to QE, including details relevant to the government's cash management operations, could have an adverse impact on the Debt Management Office operations." Now, I find that odd because yourself you said to us back in 2021 that there's no mystery about this document, quote you. And Lord Macpherson also says that it should be published. I don't think it contained anything interesting at all, he said. So either it contains something that is of great interest, or which is what the Chancellor seems to be saying, or it's totally meaningless. I take it you're standing by your view that it's no mystery to it at all and it could be published.
Well, Lord Macpherson should probably know, because I think he probably wrote it, actually. So, I've read it, as I said back in 2021. You're absolutely right, and to me it read as a pretty, it's quite a lot, it's not a short document, but it is a pretty straightforward indemnity. But it's really not in the Bank of England's power to, that's a government decision, not one for us.
Can I just gently try and probe you? I mean, does it have market sensitive, this point about market sensitivities in it? Is that what?
I have to be honest, I think you have to ask the Chancellor or the Treasury that question.
No doubt we will. No doubt we will. Okay. Well, we will write to the Chancellor and see where he gets to on that. I don't know if anyone else has anything else to say on QE or QT.
Could I just ask one?
Please do.
Do other central banks have a deed of indemnity?
No. The reason is that other central banks tend to have the arrangements set out in a rather different way, and the reason is as follows. The UK is unique. We have to go back to the 1844 Bank Charter Act now, I'm afraid. What Sir Robert Peel did in 1844 was split the Bank of England into two parts, called the Issue Department and the Banking Department, as is on our accounts. The Issue Department is there's only one thing that are the liabilities of the Issue Department, that's the banknotes in issue. They're obviously non-interest bearing assets. We invest the notes, the proceeds of the notes, obviously in interest-bearing assets, and they earn what's called the seigniorage. Now, what's unique about the UK is that all the seigniorage gets paid straight over to the Treasury, after what we deduct the cost of printing the notes and so on, but that's very small compared to the seigniorage. And seigniorage has gone up a lot, obviously, because it's basically it's unhedged interest rate exposure. So annualized basis, it's gone up from probably about £200 million a year to currently about £4 billion a year, I think, something like that, because about £80 billion of notes in circulation. Now, the reason I make this point is that other central banks have tended to, if you take the Fed as an example, they essentially book a deferred loss onto their balance sheet for the QE and are offsetting it, as I understand it, by future seigniorage income. we don't have any future standards. We couldn't do that because we just don't have any income to offset. So that wouldn't work. And I think that's one reason why the indemnity has to exist. You could say, I think you could say at the end of the day, these things are all the same. Economically, they're probably all the same. It's, if the US system didn't have that deferred asset, then the Fed would be paying more of its profits over to the US Treasury, whereas it's not going to be for some period of time. We're doing it for an indemnity, but as I understand it, that's the reason we have a different system here.
Thank you.
Can
Right.
thank Sir Robert Peel for that.
Yeah, but the indemnity is a modern invention, isn't it? It's not.
Yeah, entirely, yes. Yeah. That's separate. The indemnity is separate, yes.
Yeah. Thanks very much. Lord Razzle.
Yes, I think, Governor, I think in your detailed answers to Lord Lamont, you may have answered my question, but let me ask it anyway. Clearly, a lot of governments throughout the world are looking and have the need to finance through issuing of bonds, and we've got falling bond prices. Do you see there's a problem with appetite for UK, or do you think we're okay, or will there be any changes?
Yeah, so we've got falling bond yields. We've actually got rising bond prices at the moment, but we've got falling yields. Well, as I was saying earlier, actually, demand for debt at the moment across markets has been very strong since the start of this year. And you see that in the gilt market. So both in the auctions that the Debt Management Office are conducting for new issue and also our own auctions under the QT programme, the cover rate on the auctions is high at the moment. So I would say at the moment, there is no issue about the ability to sell debt. I think obviously we have to keep that under constant watch, though. I would say that's important.
But you don't see any problems in the medium
Not at the
term?
moment, no. I mean, I think, well, in the meantime, I'd say we have to keep it under constant watch.
And in terms of the preferred minimum range of reserves, I think that in 2023 you put that at 325 to 480 billion.
Yes.
Is that roughly where you are still?
Yes, I'd probably be towards the upper end of that number.
End.
So bear in mind, I think if I'm right in mind, we've got it's upper 700s at the moment. By the way, it was about 10 to 20 before the financial crisis, but we didn't have any financial stability protection in there. So I'd probably be about the upper end of that range. There is, by the way, another element to this that will work its way off in the next 2 years, which has nothing to do with QT, which is the so-called TFSME lending program that we did to banks during the COVID crisis, and that will come to its end during the next 2 years. That will take reserves down as well.
Right. Very good. Well, moving on then on another aspect of this is Lord Layard on national debt.
Yes, I wanted to ask you about the sustainability of the national debt in the medium and longer term, and how important it is to reduce the debt-income ratio in the coming years. Yesterday, we took evidence from various international parties. We heard that the UK has got the lowest debt-income ratio in the G7 bar Germany, and that we've got the tightest fiscal stance in the G7. So do we really need a still tighter fiscal stance to reduce our debt-income ratio?
I should say also it's for the Office for Budget Responsibility to offer their views on sustainability. I think for me, there are two things that I would sort of offer as sort of framing comments, if it helps. I think the first one is that I think what we've seen, and I think this goes across countries, what we've seen in recent years is some very big shocks, obviously COVID being a case, Ukraine being another one. You can also say climate change falls into this category, arguably, because it's about intergenerational investment. And those are have put strain on government finances, I think. And so the question, I think the question does arise, what is the sort of sustainable position on government debt? Of course, it's hard to know what shocks we're going to face in the future. The last 4 years have not been very encouraging in that respect. Second thing, I'll go back to this point about post-Second World War, which I find quite interesting to look at. We've done a little bit of work to try and sort of plot what actually happened, because we came out of the Second World War, I think, with a debt-to-GDP ratio in the quite upper 200% range, I think. And over time, it came down, over several decades, it came down quite a long way. inflation gets into sort of has a bit of a sort of complicating effect on the story, but there seem to be two underlying parts to the story as to why it came. Now, one is that the UK up to the 1970s was running primary surpluses on the fiscal side. Secondly, going back to the earlier conversation, stronger growth and stronger productivity growth were part of that adjustment story. So I think there are, I think it's very good that you're holding these hearings. I followed all of them, and I was following the one you had yesterday, because I think these underlying questions about what's the right sort of pattern of primary balances and how can growth in the economy and growth on the supply side of the economy contribute to this is important.
I mean, there's obviously the argument that when the sun's shining, you mend your roof.
Yes.
I suppose the obvious question is the sun shining at the moment? It seems to be a time when there's a lot of difficulty in funding the social services and so on. So I think it'd be really helpful to us to know how important you think, from the bank's point of view, as responsible for financial stability in this country, how important is it to actually reduce the debt-income ratio now?
Well, I don't know about the sun shining. Again, I say it's not really for us to judge that. But I think one of the things I would say is that I think the pressures on government financing are pretty severe at the moment. I mean, you rightly point to the consequences of another consequence of an ageing population. So I think in terms of governments around the world thinking about how they manage these demands on government finances, it's a very important issue, it seems to me. So that's why I think it's very good that you're doing this inquiry.
Just in terms of the vulnerabilities we face, I mean, as you were saying, compared with the post-war period, we have tailwinds that have become headwinds in terms of demography. You mentioned one. There's also, can you just talk a bit about how you see the vulnerability of our debt, because it's in terms of what its short-term nature, the maturity of it, and more of it being held by foreign investors. Should this be troubling us, or is it more the medium to long run when we're examining the sustainability of our debt? Because obviously some of those features will dissipate over time, won't they?
I think the UK, I mean, obviously, look, I understand that QE sort of complicates this while it's still in place, but I think the UK actually made a lot of progress over the years to lengthen the maturity of its debt stock, and it is longer than other G7 countries, if I remember rightly. As I was saying earlier, it's certainly longer than the US debt stock. Now, you can always say with the US, well, it's a reserve currency, so they have the sort of they have that luxury. But the UK has done a lot to lengthen the term of its debt stock over the years, and I think that was a sensible thing to do.
Right. I mean, sorry. How concerned should we be about the vulnerability of our debt as it currently stands when we're considering this issue of debt sustainability?
I mean, again, making the point that we are an open economy, I think, yes, we have tended to have probably a higher proportion of overseas investors. I mean, there's another source of demand, obviously, from domestic pension investment. I think there's a genuine question now there about what the pattern is going forwards. I mean, the government's obviously put this issue on, I think, rightly on the on the radar, as it were, in terms of what the role of pension funds also should be in so-called productive investment in the economy, because this goes back to the productivity question. So I think that has to be sort of worked through as well.
Are we over? Sorry, final question. I'm going to hand over to Lord Griffiths. But are we over-reliant on what Mark Carney called the kindness of strangers? Richard Hughes said that they can be fickle and flighty. I think he said international investors might be. And should we be concerned about that from your perspective at all?
I think we have to have an eye on it. So I mean, I don't think the evidence suggests that it's quite as volatile as that might suggest, but I think we have to have a fairly careful eye on it.
Right. Okay. Thank you. Lord Griffiths.
Mr. Governor, thank you very much for coming.
Sure.
In your response to our report, you dealt with the problem of groupthink. And you make the point, look, there's clearly diversity in the Monetary Policy Committee. There's no doubt about that. People take different positions, they vote differently on what to do with interest rates. And the Times, in commenting most recently on our report, said that one of the members of the MPC describes himself as a very convinced monetarist. So from that point of view, there's no question that there's diversity. But the person I think who captured our concern was Raghu Rana in his evidence to us. And what he said was that over the last 20, 30 years, there'd been a sort of change in fashion in the academic world of how they viewed inflation, the causes of inflation. And they put much more emphasis on expectations and central banks influencing expectations rather than central banks creating money and so on. And I just wonder, you know, as you, that's a change in fashion which started in the academic world, and obviously those graduates, they do PhDs, they go to central banks, and before you know, the whole of your economics department is now coming out with a sort of almost a revolution in the way it's thinking about inflation. And then, of course, most of these people had were very young if they were born during the early 1970s inflation. And it's really, what is your current thinking on diversity and the way that you are handling it?
Well, it's a very good question. I mean, I'd just start by reinforcing the point you made first, because I've just had a freeway split on the voting on the committee, first time since 2008. So there really is there's no lack of diversity in the MPC's voting. And by the way, I actually encourage. I mean, well, yeah, I say encourage it. I mean, I think it's important that we are transparent about the views of the committee. It's obviously all important that we do reach a decision, which we do. But I think it's important that those views are set out. And I also say, look, obviously I take one position in that myself, but reasonable people can take different views on these things, and that's, I think, always important to bear in mind. I mean, I think, well, you've had much more experience than I have. I think the academic community does have a certain amount of sort of tendency to sort of a little bit of herd-like behaviour goes on at times. I think the expectations point you make is interesting. I certainly think I'm probably in the group that is quite sceptical about forward guidance. So if that's as part of the expectation, trying to sort of guide expectations, I'm quite sceptical about it. We're really not doing it. I mean, only in the sense that you're always expressing a view about the future, but I mean, we're not doing overt forward guidance. I think it's much easier to get into. It's relatively easy to get into it, and really hard to drop it once you've got it. I mean, it overstays its welcome. And we've had these discussions on the MPC. So I am fairly sceptical about that. And there clearly was a body of opinion that thought you could, that was almost a tool of monetary policy that you could use to shape, to make your job easier. You didn't have to move interest rates around as much. And I don't think it's not, well, recent years have not been very promising on that front, let me put it that way. I mean, it's interesting about how you sort of shape that thinking in the academic world. I think central banks have to engage in the academic world, and we do, actually. But I think Raghu's right, and he's been in both, so he's right to make that point about the danger of these things sometimes becoming quite embedded.
And presumably that is something that Ben Bernanke will take into account in his review of the whole issue of forecasting.
Yes, I mean, the backdrop to why I was very keen that we had Ben Bernanke do this work is because, as I was saying earlier, I mean, we're having to use a huge amount of judgment at the moment in terms of it. Now, in one sense, put it like that, you'd say, well, of course you are, that's what you're there to do. But the tools have not served us particularly well. Now, you might say, well, if you have supply shocks like pandemics and wars, what do you expect? And I sort of take that point in some ways, but the tools have not served us particularly well. So I think, I'm delighted that Ben Bernanke is doing this work, because, I'm sure we'll learn a lot from it, both in terms of the tools, but also actually how we use them in policy making and presenting policy.
I was very interested in your remarks about forward guidance. I think the scepticism is well justified. But do you think that in the past, in the great moderation, particularly in the 90s, late 80s, do you think central banks have overestimated their own influence through words and actually underestimated effects like China? That's
a good question. Well, China has had a big effect. And by the way, it's one of the things we look at, I mean, in a sense at the moment, because when we look at the component, if we go back to almost the first question that the chair asked, if we look at the components of inflation and, you know, you say, well, what balance of components gets us to an overall 2%? Be a bit careful about looking back into the Great Moderation period, because clearly China's entry into the world economy was shaping certainly goods prices at that point, and although currently China's back in deflation again, structurally it will probably be a different story going forward. So I think that is important to bear in mind when we think about the situation we're in today, certainly.
Can I just pick you up just on one point about in our report, just picking up on what Lord Griffiths was talking about, which is about the focus on money supply, and it really comes back to our first bit of this entire conversation. I think that a number of us were concerned, or the witnesses pointed to a sense that there wasn't enough focus, and we make this point in the report on money supply. And I quote Stephen King, who's an advisor at HSBC, money supply was ignored in a rather foolish fashion, which is quite strong words. And since then, Tim Congdon, for example, at the IIMR, has been pointing to the largest one-year drop in the modern statistical record in M4 and MX. Now, to what extent is that a focal point in your discussions as you look ahead, a real focal point in your discussions? And because we were thinking that it should be more so and reflected in your reports. I don't know whether you sense that maybe that criticism was unfair. And maybe
it is, but I'd go back to the point I made earlier. I think, and probably Stephen and Tim may not agree with me on this, but I would look more at, as I said earlier, about the relationship between the stock of M4 and nominal income. I know there is a bit of a sort of philosophical divide within the sort of that world between whether you look at rates of change or stocks and levels. I think the virtue of looking at that stock ratio is that you really get to this question about, is there a money overhang or an underhang? And as I said earlier, I think we're sort of actually back on the trend line again at the moment.
Right. I mean, there's quite strong wordings. For example, Julian Jessup is sort of saying it's signalling a severe recession, I think he's going on to say. So you're saying that this is...
Well, the problem, and I know this is sort of touchy ground, but I think sort of monetary theory is excellent in terms of the sort of way in which it grounds the whole thing. It's not a great forecasting tool, right? As history would tell. Yeah,
this is overblown, these concerns.
Well, I think they're right to say you should always be looking at it and you should always be concluding. And we have a sectoral money model amongst our models, actually, and always have done. On its own, it's not as good a forecasting tool as I think some of the commentary sometimes makes out.
Thank you very much. I'm going to move on then to Lord Rooker.
Governor, my question, like Lord Griffiths really, based on our report, thanks for being so open with us. I want to give you another chance to be really open with us. When you came to talk to us, give evidence on the report, we had a long discussion about the primary objectives and the secondary objectives. You clearly made the point that secondary objectives are not without cost, create more work, makes policy making more complex. So when we said in our report that maybe the bank's doing too much, we took those points into account, which we heard from other witnesses as well. Yet you rejected them. You rejected our report. Why?
I think there's two levels to this. And if I misunderstood, then I apologise. I think at the higher level, and I'll go back to the pre-financial crisis world for a moment, I think it was a mistake to separate financial stability and prudential regulation of banks and insurers from the central bank in the way that happened. I'm afraid I think we learnt that one the hard way in the financial crisis, and I think putting them back together was the right thing to do. That increases the responsibilities of the bank. And this is what lay behind, I think, my response. I think that does make our life more complicated, but I think it's a complication that is inherent in being a central bank, and we just have to take it on, but B, we have to sort of, in a sense, ensure that I've got a management team who can do that. Second point is the one you make, which is about the secondary objectives. By the way, this is really about financial stability and prudential regulation. It's not so much about monetary policy. The monetary policy sort of the framework is actually still rather more straightforward, actually. I mean, they have grown. Now, I understand that there are very proper debates around things like competitiveness. But the size of those, those remits has grown over time, and it does make our life more complicated because we have to take them very seriously when we're given them by government and by Parliament. We have to do, we don't just toss them to one side and say, oh, I'm not going to do that. We do take it seriously. So, I said what I said because I do think it's important to not overburden the remits in that sense, because it does make our life much more complicated.
Now the Chancellor's proved the objectives by pruning the climate change issues, how does that affect the bank?
So this is on financial policy stability side, not on the monetary policy side, just to be clear. What it amounts to is saying climate actually is still included in the sort of the remit. It's what the government took out. The government in the remit states what are the sorts of what it regards are its key policies that should be a sort of we should have regard to, and it took out the things that it had previously in there related to climate. It hasn't taken climate risk out. So we've actually, we're doing this at the moment, we've had to sit down and say, what does that mean? And we still have to look at the question of what is the climate risk for financial stability, and I think there is a climate, there is a financial stability risk in there, so we haven't ignored that. But it does mean that we don't have quite such a precise regard to sort of government policies in that area, because they've taken them out of the list of government policies.
Okay.
So we've sort of tried to slim it down in that sense, and we've actually somewhat reduced our resources in that area as well.
Yes. I was just going to ask you that. So have you slimmed resources on climate as a result of this?
Yeah, we've somewhat reduced our resources, yeah. And we're currently reviewing it actually again at the moment.
When you so there's obviously how many people you have devoted to it and what they're doing. Do you think that you'll be still focusing, keeping up the momentum on this? I see that Positive Money has said that climate change no longer seems a priority, referring to this. Is that the sort of mindset you're in? It's no longer the priority it was before the FPC remit was reset?
It is very much still in the sort of set of financial stability responsibilities. What I would say is that insofar as the government has changed its focus, and as the remit says that we should have regard to the government's focus, then we have changed in that respect.
Okay, and so are there things that you were planning to do that you're not going to do now?
Well, I think there's sort of the depth and breadth of work that we do will be trimmed back somewhat. We'll sort of focus, I think, on what I call core financial stability risks.
Right. And so, just bringing this back then, does that make your life easier?
Well, unfortunately, of course, there are plenty of other risks that are coming down the track at us. So, there's sadly no shortage of risks. So there's always an issue for us about relative priorities there.
Right. Okay.
I mean, we are having to put more, to give you an example, more focus onto operational risk and yet more focus onto cyber risk, for instance, in that world.
Right. Lord Turnbull.
In our report, paragraphs 124 onwards, we highlighted some concerns about financial modelling and how those models were used. Interestingly, before our report was published, you had already appointed Ben Bernanke to review this field. So clearly, you had spotted shortcomings in this area. So could you tell us a bit more about what you thought were the problems there, and what solutions you hope Ben Bernanke might come up with?
Well, I think for me, as the thing I was saying a few minutes ago, I know some people have said, well, the bank's obsessed with one model, and that wasn't the case. The problem is we have a suite of models, but we were in a situation where that suite of models was not really giving us what I would call the guidance and assistance that we would like to have. So there's a lot, as I was saying earlier, a lot more judgment having to be applied by the committee and by the staff to help us through these things. And wage equations are a pretty good example of it, frankly. So one of the origins of the Bernanke report was to say, look, we really do need to sort of take stock of this and decide that other things that we could be doing, we should be doing, that we're not doing that we really ought to be doing in the future in that world. I think then there's at least two other parts to it. I think one is then how within the bank we organise ourselves, how the modelling work is organised, how the data work is organised. Yeah, again, you've got things like, as I was saying, things like AI coming along. And then I think a big thing for us is how we present that, how the committee presents it. And I think that's something that, you know, I've also encouraged. So, you know, for instance, I mean, we've had the fan chart for, well, ever since the beginning of the MPC, so over 25 years. Is it still the right way to convey uncertainty and risk? Would scenarios, for instance, be a useful thing for us to do? I think we, amongst central banks, in the way that we do it, put a lot more weight on the forecast in presenting policy than others do. And that has, I think, pluses and minuses. I think we do try to give, you know, our best view at the moment. But yeah, I'm always conscious, and I have to say the other day, that all these forecasts are conditional that we do. They're conditional on yield curves, energy prices, fiscal policy. I'm afraid once they get into the outside world, they're treated as unconditional immediately. You know, are we putting too much weight on a central case? Should we have scenarios? So I think these are the questions that I'm, you know, very keen, very grateful to have Ben Bernanke looking at.
What is the timescale? Has he started work?
Oh yeah, no, he's well into it. In fact, you know, he's busy writing, as I understand it. So I think, you know, sometime in the spring it will appear. I think I'm not sure exactly when, because he's busy, hard at work.
Lord Ladd?
Would it be correct to say that up to about 20 years ago, the central model was focused on the wage price spiral, and that then was dropped, and that is now something that you're wanting to reintroduce? Is that the right way of thinking about it?
Well, I mean, this may not be the right answer. Tell me if it's not. I mean, if you say, I mean, there's always a variety of Phillips curves in there. So, you know, the heart of these models, you know, most of them, there's always one of those, yeah, something like that in there. So I don't think that, you know, they haven't changed that much in that sense. There's a variety of ways of getting to it, I think, but they haven't changed that much.
But wages being a more central issue than they were in the model that you've been using for the last...
Well, we've got, I think I'm right in saying this is the chart we've used a few times. I've used it. I think we've got 3 wage equations. And we produce what we call a swathe of which essentially is the output of those 3 equations. And then we show this line above it, which is actually where the committee is actually setting the path of wages. And what that's telling you is that these 3 equations are not about, you know, they're telling us something, but they're clearly not telling us the answer in that sense.
Baroness Wolf?
Yes, could I come back to the point you made that in terms of forecasting, the bank does more than many other central banks, and you know, you said earlier that the wage models weren't working very well, and we know that the model hasn't been working very well. And I suppose there's sort of 2 questions. First of all, is anything working well? But more seriously, surely you have to have some sort of models going on. So is the difference really in the way that you make decisions, or is it more in the fact that the bank goes out into the world and actually lets it know what the forecasts are? And is that helpful?
Well, all central banks do that, and it's a great question. All central banks do it in a slightly different way. So the Fed has so-called dot plots. For each member. We produce what we call a best collective judgment forecast, but then obviously, you know, I perfectly understand that some members of the committee are more signed up to it than others. You can tell that from the way they vote, obviously. In some other central banks, the staff produce a forecast, and you can sort of try and work out, you know, to what extent that's passed through into the sort of the policy-making judgment. It's obviously an input to it. But the policy-making judgment is obviously more described in words than in in forecasts. So there's no great sort of common ground. There's not one uniform model for how central banks tend to do that sort of thing. I think we, and people have said this about us over the years, that I think we're far more, I'm not sure who used this term first, we're more an inflation target forecasting institution sometimes. So we do, the forecast is always sat in the middle of it. But it is challenging at the moment. I mean, what I would say to the other part of your question is, I mean, it's not that we haven't thrown the sort of the theory of the models out. I mean, that still drives the sort of, you have to have a framework, and by the way, you have to. By the way, I would also say that we do have a central model, because ultimately things have to add up. And the component parts of GDP have to add up to the total of GDP. It can't, and you have to. Those are sort of simple errors, but you do have to avoid them. So there's a framework sitting in the middle of it, but we've had to go out of the models but hang on to the theory to come to these judgments, I would say. And we do, as I say, we do use a lot of information from, for instance, from our regional agents to inform then the judgments that we make.
Thank you, Lord Burns.
Could I return, Governor, to some of the opening points you made about today's inflation rate and this whole question of uncertainty? One of the things that struck me, looking at it relatively quickly, was that we seem to move to a position where many of the special events seem to have come out of the numbers. I mean, so many of the different definitions now look within quite a narrow range when one looks at groups of prices, and that whole period of saying, well, this is all being affected by energy prices going up or energy prices coming down or food prices. Is there some danger that we're going to get stuck with inflation at around this rate of, or 4%?
Well,
the last part of the journey is going to become much tougher than it has been so far. And how much appetite is there really going to be for this final stage to get back?
So the forecast that we had in the report we published 2 weeks ago indicates that it's going to come down to about target by spring. Now, the reason for that is back to energy again, one reason, which is actually in today's number, there was it's a slightly sort of strange thing to say, there was a bit of upside from energy in the sense that the latest Ofgem reset has meant that it wasn't falling quite as fast as it was. However, I think I'm right in saying that the Ofgem period comes to an end next week. So we're well now through the sort of observation period. The next Ofgem reset looks like it'll have quite a drop in it. Now, by the way, this, of course, is one of the interesting things, and we were wrong on this in November, but I'd sort of defend why we were wrong. I mean, if you were back in early November, a month on from the sort of terrible events in the Middle East, and drawing on history, if you'd thought oil prices are not going to go up, gas prices are going to come down substantially, predicting that back at the beginning of November with what was going on would have been quite hazardous. But that's actually what's happened, for a variety of reasons. So it looks like we're going to have quite a further leg down in between now and sort of spring, April, May time. On what we published a couple of weeks ago, we think that will sort of stay around for the summer, but the base effects will start to go into reverse. But just to be clear, because it's important to put this into perspective, I think we had it going back up to just under 3 again, so it's not back to where we were, fortunately. But obviously we've then got the task of getting that sustainably back down to target, and that's why we've taken the view, and I've certainly taken the view that the issue now is how long do we have to maintain be restrictive to get that. It's that leg of it that matters. I mean, what happens in the spring is not going to be the thing that determines the stance of monetary policy in that sense, because we have to hit targets sustainably.
As you speak, I was reading an interview that Isabel Schnabel gave at the ECB, I think about 2 weeks ago, and she said we're probably past the peak of transmission. Would you agree with that in terms of the UK?
So it's an interesting question. So back in the beginning of November, we spent a lot of time on the transmission mechanism for reasons. So back in the November report, at the beginning of November, our staff said to us they thought we were about 50% of the way through the transmission of the rate of the rises that had happened. When we did the February report, they said we were about 70% of the way through, and that's for 2 reasons. One is because obviously some more time had passed, but actually more particularly because the yield curve had come down so much that, if you like, the denominator had changed. In other words, there isn't going to be as much tightening, and therefore the tightening that's happened is a bigger proportion of the eventual tightening. So that's the reason. So staff estimate about 70%.
Right. Very good. Lord Blackwell wants to come in on.
Yes, Andrew, could I just raise a different topic related to the excellent speech you gave the other day on bank profitability and valuations, since we've got a moment. Yeah. In that, you raise the prospect that banks' valuations may be affected by a higher risk aversion, a higher risk premium in the discount rate applied than historically, which would seem counterintuitive in some ways, given that they're all holding that much more capital against those risks. Do you have a view on whether that's, to the extent that's rational, because of perception of externalities like cybersecurity and wars, etc., or is there a perception? Do you share a perception that maybe the years of low interest rates have left the banks with loans that may be difficult to maintain in the high interest rate future?
It's a really interesting question, and I have to confess, I mean, I did end up sort of with that speech saying there's still a puzzle. First of all, I think the UK banking system, I think, is in a very sound condition. I think it's come through these major shocks well. Actually, we are not seeing. I mean, we're seeing a bit of a tick up in impairments, but nothing. Sort of, if you compare it with history, this is nothing by some of the standards of history. I think net interest margins, as I set out in the speech, are now broadly back to where they were pre-financial crisis, i.e. going back to the previous time when we had our interest rates in the sort of more normal territory, that this adjustment that happened when the official interest rate was near zero, when the banks were actually paying rates above our rate, whereas normally they pay a bit below our rate. We've, in a sense, that's reverted back to sort of its normal relationship, so net interest margins are a bit wider. So, and obviously, we have got more capital in the system, but that, as I said, doesn't determine, as you point out, doesn't determine the risk in the system. So the puzzle does remain. Now, maybe, you may be right. I mean, maybe there are, externalities out there which the market is valuing. I think it remains a puzzle to me, I have to say, and I think it's something we've just got to, with the banks, do more work on, because there is a puzzle out there. Because I think the system is fundamentally in good health. Dividend payouts are now back to pretty solid territory. So I think the valuation question it does remain a puzzle, actually. Yeah.
Thank you.
Yeah.
Can I just, sorry, it triggers the thought that was related to what Lord Rooker was asking about the competitiveness and growth objective. That's now coming in or enacted. What difference is that making, do you think, in practice, that objective?
Well, I said in the much Lord Blackwell's question, I said in the speech actually on Monday that I think as we come to we're sort of coming to the tail end now of the post-financial crisis. Believe it or not, 15 years on, we're coming to the tail end of the sort of post-financial crisis capital regulation and liquidity regulation. So it's a so-called Basel 3.1 package. And I deliberately said in the speech on Monday, I think now is the time to make sure, from a point of view, competitiveness. It won't be exactly the same in every country because we have different sort of local arrangements and different local structures. But I think now's the time, in the spirit of that competitiveness objective, to say, do we think it's broadly in the right places from a sort of equivalence point of view?
Right. And in terms of that debate over equivalence, and I'm thinking here really about the EU and where we go in that. Do you feel
that's formal equivalence, you mean?
So, that sort of equivalence. So this is triggering a thought in my mind when you mentioned that word, bringing back those Brexit days. Do you feel that we have got a clear path and strategy for the city as we move ahead into a post-Brexit world in terms of competitiveness and whether or not we should be diverging or aligning in certain areas?
Well, my view is that it was. I've always said I don't take any position per se on Brexit. I'm a public official. I shouldn't, and I don't. But we've obviously got to get on and implement it and do it in the most sensible fashion. I think in financial services, actually, I think we have made quite good progress on that front. I've been very clear actually since the day after the referendum. Funny enough, I said to staff, it's important that we do not become isolated and isolationist. And I don't think we are. We're very active in the international agenda. We've kept good relations with our EU counterparties. Now, I think things like the Windsor Agreement help in that respect, in the sort of background mood music. I think it is important because on the whole, there is every reason on both sides for us to cooperate. And the other big thing I would stress here is that it's often presented that the sort of, this all goes one way, that the EU has a huge dependence on the City of London. And there is obviously a lot of EU business done in the City of London, and I think things like the clearing debate actually emphasise the benefits of having a single, the benefits of sort of, in a sense, concentration. But if you look at something like the LDI issue, you see the other way around. We have a dependence on the EU as well. So almost none of those LDI funds were domiciled in this country. They were domiciled in mainly Ireland and Luxembourg. Now, we have good relations with Ireland and Luxembourg, so not a problem there. But I always point out to them, look, this is a two-way street. So, we do need to get on because, frankly, the dependencies go both ways in that sense.
Mm-hmm. Very interesting. Lord Virgie.
Governor, could we switch to central bank digital currencies?
Yes.
Could you give us your current thoughts on where we are on the digital currencies? It seems the Europeans are sort of got their foot on the accelerator, perhaps, whereas the Americans are a little bit reticent. And also, could you tell us where sort of China fits into all this as well?
I think you're right. I think the Americans are a bit more reticent. I think the Europeans, they had their foot on the accelerator, but I think there's a bit more questioning going on now about just how it will work, as where I read it in sort of places like the European Parliament and so on. I mean, the Chinese have introduced one. I'm not sure it's had that much of an impact, though, actually. It's quite interesting to look at. It doesn't seem to have made that much of an impact, but they have done, and many countries are obviously looking at it. So where we are, so we in the Treasury put out a response to the consultation. We got 50,000 responses to the consultation, which is the most we've ever had by a very long way. I'll give you my view on it. I think the most important question is actually not about central bank digital currency, it's about digital currency. And you can say, what do you mean by digital currency? I think it's about programmability, of using greater programmability in the payments world particularly, and taking advantage of those. To what extent particularly I'm talking about retail now. Wholesale, I think, will happen actually, and it's a different world. To what extent can we take advantage of that in terms of outcomes? Say, I don't claim to be an expert in this field. Things like late payment, could you make real progress if you actually could greater programmability of payment? Say, if I deliver that service to you, I'm going to program the payment, to arrive, when it should arrive, not sort of a month later. I don't know. I think the technology could help there, for instance. Now, the reason I say that it's digital currency is, and I'm talking to the banks a lot at the moment, and I've said to them, look, this is not about central bank currency, it's about using digital technology. I don't want to disturb the balance of central bank and commercial bank money in the system. It sort of goes in some ways the parallels of things I said on Monday at the speech in Loughborough on liquidity regulation. This is because then that starts to disturb credit creation in the economy. We don't want to do that. So I have, to put it a bit more bluntly, I have said to the banks, look, I don't really want us to be left as the only game in town on this front, and doing it because if we don't do it, then it's not going to happen, and there's a sort of case for doing it. So we're talking a lot to the banks at the moment about it. I think those are important conversations. I don't know where they'll go to at the moment, and then we can decide, in the light of where we get to on that, whether there's a case for central bank digital currency or not. Or we may say, actually, we don't need it because these other, once we've sort of, I mean, you've challenged us in the past quite rightly to say, what problem are you trying to solve here? Well, I think, if we do identify issues that can be solved this way, then once we've identified how they can be solved, we can answer the question which you've put to us, and I would agree with, which is, does it require central bank digital currency or not to do that? And we'll get to that answer, and we'll be very transparent. I'm happy to come along and discuss that at any time.
Thank you very much. I don't know if anyone else has any other questions. No? I think then, Governor, thank you very much indeed.
You're very welcome.
A great amount of ground, and with that we'll end the session.
Thank you.
Thank you.
Thank you.
The proceeding has ended.